Cool. Well, welcome everyone to our webinar, which is focused on how to finance capital-intensive green energy projects. I'm very excited about session today because we actually got a wonderful speaker. The speaker is Santosh Raika, a great colleague and friend. I will kind of introduce and invite him on stage a little bit later. But I wanted to use this time wisely while we're waiting for people joining. And we have people from different time zones joining. So I don't even know, for some morning, some is it's evening, right? So kind of I welcome everyone. And in the meantime, I would like to quickly talk about who we are. So we are founders of QPQ International. QPQ International, and I apologize because I know that many of you already know us, but we've got like 600 registrations today. And I kind of just want to make sure that those of you who don't know us have kind of introduce ourselves briefly. So QPQ International is it's a digital platform focused on facilitating investments into green energy sector. We primarily focus on renewable energy, waste to energy, hydrogen production, and energy storage. So yeah, our kind of mission is to make our planet green again, so our children have an inhabitable world to live in. And this is a part of the series that we are hosting, and is a part of the funding accelerator, green energy funding accelerator program that we are hosting. It's a year-long program. And this is already, Vladis, I think webinar 5 now that we're hosting, right? Yeah, I think it's number 5. And I think many of you have attended. So I've received a lot of emails and messages from people saying that they're attending. So welcome you in this room. And back to the funding accelerator program. So basically, program is created to support and help green energy project sponsors worldwide to accelerate, advanced development, accelerate financing, and secure world-class partners and funders on optimal terms. So we work closely with now, as of today, over 400 international investors worldwide. We work with closely. We have some already kind of strategic partners as well. We collaborate on ongoing basis. We are basically the programs that are being, or the projects that are being groomed as part of this program. And as part of this program, basically, project developers go through series of interactions with our advisory team. It's a bank. First of all, we assess and vet the project. We filter those projects. Then the qualifying projects go through bankability assessment and various other steps. I don't want to kind of, Vlad, can you please share the handouts and link to our funding accelerator program? Project
development on the second side where you guys can see chat and handouts, you will be able to, in the chat, you'll be able to post questions, which our presenter who's going to come on stage in a minute, he will hopefully have enough time to answer in the end of the session, but also in the handouts section, you'll be able to download the short brief about us and also the presentation that we're going to be going through today.
Great. So yeah, so basically that's it. So if you are a developer and you have a track record, have professional team, because this is our qualifying criteria, and you are in the sector, have projects in renewable energy, waste energy, hydrogen production, or energy storage, and you look for world-class funders and partners, do consider joining, submitting your project. Projects are handled with utmost confidentiality. Once project kind of been qualified and groomed, then on very in very bespoke manner, we present those projects to selected investors in our network. Do submit your project, reach out to us if you have questions. And if you are an investor, we do kind of please, and you are not in our network or we don't work with you at this stage, Also, please kind of drop us an email. Or how can people, just through LinkedIn, perhaps, on LinkedIn,
or on the Funding Accelerator program page. There are our contact details available.
Yes.
So
you can also send my email here in the chat as well.
Here in the chat,
Yeah. So because we, as part of this program, after vetting and filtering, we get to in excess of around 2025 utility scale projects per month. So this is quite a lot of projects. So if you want to kind of collaborate and receive premium, wonderful investment opportunities from us, do kind of reach out and let's connect for a conference call and better understand your investment criteria and goals, so we can basically be sharing suitable projects with you as they become available, because a lot of good projects go very fast nowadays. Everyone knows what's happening with green energy market and energy markets in general. So I will not take any more time. Thank you very much for listening. Thank you very much for attending. And now it is with a great pleasure, I would like to introduce a great friend and colleague, Santosh Raikar, who is a managing partner at Silver Peak Renewables Investment Partners, person with incredible credentials and track record. Santosh, thank you so much for joining us and kind of supporting our developers and our attendees. We have a kind of mix. There will be investors here and developers as well. I will know I think you'll be better. You perhaps can go into telling a little bit more about your track record, what you've done, and you've done a lot, and especially your wonderful book, project, renewable energy project finance. Interesting. I was talking to one of our advisors, and he said, I bought this really cool book and I'm reading it. And he shows me your book and I say, yes, this is Santosh's book. So there you go. Santosh, you're known in the circles. So I'm very privileged to have you here. Stage is all to you. We're going to leave the stage now. And
we will be able to hear you. If you have any technical issues or questions, you just talk to us. I'll jump back on stage and help you to sort it out. And also, attendees and then people who are with us today can post questions in the chat. We will get back to those questions in the end of the session once you finish with your presentation. Okay, thank you very much for, it's a pleasure having you today here with us.
Thank you, Santosh.
Great, thank you. So thank you, Oksana. It's always a pleasure speaking to you. Hi, my name is Santosh Raikar. I work at Silver Peak managing the renewables business. I have been in the project finance business for almost 20 years. Since 2008, I have been working purely on the renewable energy, 100% renewable energy. So, that's sort of my background, that's my passion. And in terms of my background itself, I worked at investment banks before. I was at Deutsche Bank for 5 years, and then I was at Lehman Brothers. And then I've also worked for a couple of solar manufacturing companies in the US. And then for a long period of time, I worked at State Street, where I made investments in the tax equity space. So I've been with Silver Peak for more than 3 years now, and we invest into all sorts of renewable energy projects in the US, primarily in the sectors like wind, solar, batteries, EV charging, microgrid, green hydrogen. We are primarily a US firm and US-based focus, but hopefully in the future, we will go into other countries. It's a pleasure to be a part of this eclectic and internationally drawn a group here, and look forward to a vibrant and interactive discussion. I'm going to primarily focus on the project finance, and if there are any questions, I would be happy to stop. But I don't believe that this needs to be a one-off conversation. So if there are any follow-up questions, please connect with me on LinkedIn, and then we can continue the discussion over there. I'm going to share with you my screen so that you can see the slides. Just give me a second. So as Oksana told you, I teach at Boston College and Sloan School of Management, basically covering all the topics that we are going to cover here today. And some of the slides I have pulled from are from the classes that I offer. I'm not going to be pedantic in the sense that all of you have fairly extensive background in project finance and what we are going to cover here. But at the same time, I want to really get to the bottom or the root of why people do the things that they do, especially from the banking and investment perspective. I'm pretty sure you have come across banks and they have always asked you, and you always wondered why they are looking at this, in a somewhat counterintuitive way. And that's sort of the, some of the myths I'm going to hopefully dispel here. So that's the purpose of the course here, or the lecture here. I mean, I'm sorry, I'm going to be in the classroom mode, so I'm going to say the course or lectures, but that's what it is. So here's a quick outline of the what we're going to cover. Again, I'm not going to go through each slide separately, because I have plenty of materials to cover here, but I wanted to keep everything in one place so that if you want to refer to this later on, you can in your spare time. So here's the one slide. I'm pretty sure you have seen it. It's a year or two old, and I like to share this in my class when I teach at Boston College. It basically gives the snapshot of what happened in year 2020 or 2021, one of the 2 years. I think it came. I pulled this out last year. The purpose of this particular slide is the amount of capital that goes into this. You will see that somewhere around here, number $120 billion. That's the amount that was invested in the renewable energy sector in the US alone. So the reason why I'm putting this slide out there, although you have seen it, is the sheer amount of capital that the renewable energy industry requires. If we are moving to the net zero type of economy, we really need trillions of dollars to get invested into this. And that's the nature of it. And most of that capital, like it or not, is going to come from the private, private resources. So that's where the project finance as a financing mechanism is very important. As a historical lesson, the first project finance deal was done in the 13th century. That was when the British Crown granted a license for a silver mine. And so, and over the period of time, I mean, over the centuries, the tool has evolved, and a lot of innovation has made its way into the project financing structure. So it's very fascinating and evolving field. So with regard to the financing itself, what does it mean, project finance? So there are two important delineating features that one need to keep in mind. One is it's financing a single or a group of projects on a non-recourse basis. Okay, that's the first distinguishing feature. And then the second feature is it's done through a specially created a single purpose entity. Now, if you take into account those two factors, that you are financing to an entity that did not exist until yesterday, and you are going to be reliant upon the assets that this particular entity owns for the repayment of your loan, it should tell you that what you need to do is really closely watch this project. There is an adage which says that if you have a lot of eggs that you need to take care of, better keep them in one basket and watch that basket. It's a similar kind of thing. And so a lot of things that we see in the project finance world is really what I would call an outcome or artifact of these two particular requirements, or the two distinguishing features of project finance, right? So when it comes to the non-recourse and recourse, basically what it means is that the recourse to the sponsor in the project finance structure is generally limited, which means if the project goes bad, you cannot really go after the sponsor. Now, if you're doing a corporate financing, that's not the case. And I think I have a slide next, the next slide will delineate what it means by financing on the project finance basis and the corporate finance basis. And then since, as I told you, you are doing it on a non-recourse basis for a newly created single purpose entity, you have to make sure that you have a contractual framework and you really can bank upon the technology of the project. So that's a single, that's an important characteristics or important criteria that you have to follow. And then in terms of, because the cash flows are coming from the project alone, so you need to ensure that you have a long-term financing contract. that could potentially enable the bankability and success of this project financing. So here's a quick comparison between what it means by corporate finance and project finance. I'm not going to go through this, but I just wanted to delineate that, a typical corporate financing where a company is borrowing on a on a fully recourse basis as a corporate bond, have access to this capital and they can use it whichever they want. Whereas in the project financing structure, the financing is to the entity which owns the project and is going to be repaid out of the cash flows generated from the project. So that's the main distinguishing factor here. Of course, there are other important delineating points too, but I'm going to kind of focus on that. Here is the project finance market overview. Now I'll tell you there is a reason why the data that I'm presenting here is somewhat old. And the reason why this is old is I want to make the point that especially the market has been pretty much flat, in terms of the volume. When you compare, variety of different factors in terms of different sectors in terms of the project finance. And so, it's comprised of power, renewables, oil and gas, infrastructure, and others. And there are always movements within the groups, but they as a whole have remained the same. In the bottom right corner, you will see that there are banks which are involved. And again, these are league tables. They are meant as bragging rights. And while the composition of the banks, while the particular contribution to the deal volume has varied, the composition of the bank has remained the same. So really what I'm trying to tell you is that it's a roughly a $400 billion market on an annualized basis. And good chunk of that comes from power and renewables. And then the other thing is, which is important is that a lot of volume is done really in Asia Pacific and EMEA. And the reason is in the Americas, there is a public finance mechanism available through municipal bond issuance, and that's why that market tends to pale in comparison to the other markets. And then the final point I wanted to draw here is that look into the top, top left chart here. What it tells you is that the project finance loans is a significant contributor to the overall financing volume. It also tells you that generally speaking, the amount of equity that goes into the project finance structures is fairly small compared to the overall capital that goes into the project. So if you think from the LTV perspective, loan to value, we are looking at 10-15% capital going in as equity capital. So these projects tend to be very levered. And the reason why they are levered is, despite this being a non-recourse financing, is the cash flows are fairly robust, especially an EBITDA margin, especially for the renewable energy projects, can be very high, like 90% margin, in certain situations. And so that's the reason why you could potentially have a pretty high leverage on these projects. So there are multiple dimensions of project finance. It's a fairly complex asset class, and some of the transactions can go from several months to several years. I have worked on some transactions which took like 3 years, for example. Why? Because just the variety of different things that go into the projects. For example, you might be talking about oil and gas, you might be talking about pipelines, power plants, renewables, refineries. They all work differently, right? And therefore, you have to understand the nitty-gritty and the idiosyncrasies associated with each of the asset class. You may have projects in different, different countries, and your financing might be, you might be in, like, say, for example, in Thailand, and therefore, but your financing is in, Japanese yen or euros or US. So you need to really understand the currency imbalances and provide for mechanisms that could potentially shield the financiers from the variances in the currency, for example. In terms of the financing sources, there is a bank market, there's a bond market, and as I say, in the US, there's a public finance primarily dominated by the munis, and there are a lot of multilateral institutions get involved, like IFC, OPIC, which is now DFC, in the US, and things of that nature. Interest rate and inflation are a big driver. A lot of, forgetting about the renewables for a minute, looking into some of the infrastructure projects, a lot of revenue sources are driven by the inflation. And therefore, you have to sort of look for the inflation and interest rate risks as well. And finally, a couple of other structural matters, domicile matters. If you are in the emerging markets, you want to create an entity which is in a relatively favorable jurisdiction from the bankruptcy law perspectives. People use usually Cayman Islands or some of the other offshore entities purely from the perspective of having a neutral jurisdiction. And then there are accounting, tax, bankruptcy, regulatory issues which may be mundane to a particular jurisdiction where the project is located. So it's a fairly complex asset class. Now the good news is for all of us, working in the renewable energy sector, we have to deal with a fairly well-defined set of incentive mechanisms and variety of the things, and therefore some of these complications are not necessarily prevalent. But I wanted to give you a little bit of overview about what project finance as an asset class kind of works out. So here is a typical structure. I always like to tell my student that this diagram might look a little bit busy, but it is really a simplified representation of what a typical project finance structure might look like. I would encourage you, if you could find some red herrings or the pre-offering memorandums on the SEC website, for example, where the bonds are registered, and look at some of the diagrams, and they do take 3 or 4 pages. So it's a somewhat simplified, and some of you must have seen that, but I wanted to point out. So generally, when I look at this diagram, and I'm going to spend a few minutes on this, quite a few minutes on this, because everything can be explained with this diagram, in my opinion. And so the way I look at it is, every project really starts with an off-taker and some sort of a off-take agreement, right? That, in my mind, is the seed that grows into a tree called the project. If you look into, for example, financing a wind project or solar project, the first question any financer is going to ask is, what is your off-take strategy? Why is that? Well, as I told you, all the financing are done on a non-recourse basis through a specially created single-purpose entity, and therefore off-take matters. Remember my analogy about the eggs and the basket? And this is the off-take is the one which is going to drive the revenues and potentially the cash flows for the project, and you really need to have certainty about it. So there are 2 attributes here. One is there is a off-take price. Obviously, you want as high a price as possible, but the credit of the off-taker matters too. And so for example, you have an entity which is CCC rated. Even if they are offering you, double the price that a typical credit-worthy counterparty offer, you don't want to take that. Why? Because you do need this entity to be around until the project and the off-take contract, goes to the sunset. So that's very important. Fortunately, most of the times, at least in the US, most of the off-takers, coming from the utility space, tend to be investment grade. I mean, there is a report which is somewhat old, but more than 94% of the publicly traded, IOUs or investor-owned utilities in the US are investment grade. That means they are BBB minus or better, which provides the creditworthiness that you need. And any financing party looking to finance, whether it's loan, bond, equity, are going to look into the quality of the off-taker. That's going to be the important criteria. So let us say that you have an off-take contract, and now you want to, sort of build a project. What do you need? Well, you need an EPC contractor. You need to go out and, have somebody build a project for you. And so that contract is very important. Why? Because not only the dollars and cents that go into the contract matter, but also you need to have a contract which is, robust. There are provisions which take into account the delays. For example, we just came out of the COVID pandemic, and a lot of projects had to declare force majeure, and there were a lot of disputes about it with the EPC contractor. And so there are always situations which are beyond the control of the EPC contractor as well as the project sponsor. And so, that's what, it's an important consideration. And that's where actually most of the dollars go in terms of building the project. Then there is a O&M provider. O&M stands for operation and maintenance, as all of you may know. You need a good contractor to basically run the project. Why? Because they're going to make sure that there are no cost overruns, the EBITDA margins are protected, things which are unforeseen, beyond our control, are attended to. If there are any spare parts, there is an inventory, and and those kind of things. And we have seen it, and we have heard about horror stories about how some of the things could go wrong, and that's what it is all about. So a good quality O&M contractor is very important. Oftentimes you can get a third-party contractor, or sometimes a sponsor could potentially do it on an arm's length basis, basically. So those are the parties which basically put together the project, and sort of make the project happen. Then obviously there is our lender. Now here you will see that in this picture there is a lender in two places. One is on the right-hand side, on the corner, and then there is on the left-hand side on the top of the box. Why is that? Well, there are a couple of ways you can finance the project. One is financing it on the at the project company level, which is basically, we call it a front leverage, or you could do financing on the back leverage basis, which is why it is sitting at the holding company level. If you are familiar with the second mortgage for your houses, you will find that, and again, I'm giving some US terminology, but just to give you an idea, your project lender is basically your mortgage lender, and your holding company level back leverage loan is more like a home equity line of credit, where they're basically borrowing against the equity of the project. That's the main distinguishing factor here. Why do we have it two different ways? Well, you need sometimes back leverage because you can get additional debt out of the project. That's one, usually the common consideration for the international community. And then oftentimes in the US, the tax equity is involved in the US in the projects, and you need some sort of they basically are averse to having the lender foreclose on the project in the event something goes bad, and therefore they want the lending to be done at the equity level, and therefore it's at the back leverage level. And because it's at the back of the in terms of the security, that's why it's called back leverage. Now, in order to enable all of that, you need to have a holding company, and then as of now, I haven't really spoken much about the sponsor, but that's the sponsor on the right-hand corner on the top, which basically contributes the equity and makes the project, basically oversees the project. And then obviously, depending upon if you're in the US, you need to have some sort of a tax partner and an LLC agreement that drives the interaction between the two parties, as well as they can help you monetize the tax credits, which is the primary means of subsidies in the US. So that is really what the project finance structure looks like. And really, the project company that you are seeing here is going to be the borrower of the record, and they are going to be the one which is going to be servicing the debt, and therefore, that kind of sits in the middle. So having spoken about all of this, there are multiple project contracts, right? We talked about power purchase agreement. It could be for the sale of brown electricity or the green attributes, right? In the US at least, and many other jurisdictions, you can take green power and you can strip it apart into two parts. One is dealing with the electricity, which is, we call it brown electricity, and then the green attributes can be sold separately. And there could be two different contracts for that. As I mentioned to you, the credit quality does matter. And then obviously the power purchase agreement enables the financing of the project. Therefore, the off-taker wants a variety of different performance metrics, and some of those might be related to the minimum delivery obligations or the quality of the electricity that they're getting out of the project, or a variety of different aspects. So that's a pretty heavily negotiated document. We do need interconnection agreement. Why? Because most of the projects, renewable energy project, whether it is geothermal, somebody mentioned, does renewable energy cover geothermal energy in the chat session? And it does. And, some of these projects are located fairly at a far distance from the load center or the population center. And therefore you need access to the grid. and the interconnection agreement enables that. It's basically an agreement, just like you are building a fairly large apartment complex in the middle of nowhere, and you need to get access to the highway. It's a similar arrangement. You need a short, sort of line that connects your project to the grid. But the grid operator has to give you a permission to operate and connect to the grid, and therefore, you need to sort of abide by their criteria. There's a lot of studies involved, and I'm pretty sure some of you specialize in that particular area. I spoke about the engineering, procurement, and construction contracts, the EPCs. Obviously, what matters is, at the end of the day, all we want is take our money according to the payment schedule we agreed upon, just build a project, and then just deliver it to us, right? Unfortunately, it doesn't work all the time that way, and therefore you have to deal with the delayed damages as well as the liquidated damages. And of course, the project has to operate as advertised, and therefore you need warranties and guarantees. So it's a pretty heavily negotiated document too. And then the same goes with the O&M agreement. It's just kind of looking into what could happen over the long period, and therefore you want to make sure that the project operates. One of the challenges of the project financing is you have to kind of envision this project for the useful life and basically work everything out so that it's an autopilot, right? So everything is codified. What happens if this thing goes wrong? What happens if the project does not perform according to the standards? What happens? There is a breakage, outage, and all of those things. And therefore, there is a contract, there's an LLC agreement, there is a operating agreement, and everybody goes to that and basically try to decipher what needs to be done. Very important consideration. So what happens is the documentation for the project financing can be very tedious. There are other documents here which I'm not going to go into detail because the primary documents are the four documents that we talked about. So that's what we have in terms of the structure. So ultimately, when it comes to someone like me, and think of me as a lender or an underwriter at a bank, I need to look at that whole package and make a risk assessment. So I'm going to talk about some of the things that go into assessing the risks here and figuring it out what could go wrong and things of that nature. So there are multiple dimensions here on the risk spectrum that we need to worry about. We need to worry about the project being constructed on time according to the specification, and therefore you need to go through the EPC contract and make sure that there are adequate protections there, and you're not going to find yourself a half-complete project. I will tell you one thing. The worst thing from the lender's perspective is half-complete project, because that's where the recovery is very low. Generally speaking, I'll show you some data which will tell you that the risks on these projects is fairly minimal, but that is only after the commercial operation has achieved and there is some track record. The risk goes way down, but the construction is where most of the projects fail. That's just the reality. Having said that, things do go wrong during the operation phase as well. Event like Fukushima, for example, happens, and you have to make sure that you have enough coverages from the insurance perspective. You have enough, financial wherewithal to adequate reserves to take care of certain unforeseen circumstances and those things of that nature. Now, with regard to the renewable energy project, the commodities are not that important, except for maybe biomass project where you need to secure the fuel supply. So I'm not going to go too much about it. Offtake we talked about, the transmission interconnection we talked about, but these are fairly involved risk assessment. So that's where you spend as an underwriting process quite a significant amount of time. Now, with regard to the renewable energy project, there is a unique risk with regard to the resource. What do I mean by that? We are building a wind farm. We do have some data, and we are extrapolating that data through the useful life for a wind project, which is 30-year long. So you need to build a fairly robust resource estimate as to what would happen with regard to that project. And so, generally speaking, in the project finance industry, there are consultants everywhere. I'm pretty sure some of you work in the consulting industry. And then, you basically go and find a person or a firm that can help you assess the resource, and therefore, you can make an assessment as to the profitability of the project. So that's, I would say, after you take away the offtake, that's where we spend a lot of time from underwriting perspective. The regulatory risks are everywhere. Obviously, I talked about interconnection. There are several variety of different, regulatory bodies you need to satisfy. In the US, it's even more complicated because there are regulatory requirements both at the federal level, at the state level, at the county level. So you need to go through multiple hoops to make the project work. The project administration really relates to, taking care of the project, things like security, making sure the lights are on, the insurance is, paid on time, and accounting is done properly. These are not trivial tasks, and there are certain firms which specialize into that. Political risks are important when you are working in emerging markets. Think about Venezuela, for example. Unfortunately, the government seized all the assets, so you need to think about that. There are organizations like NIGA, for example. OPIC used to do that, which provide political risk insurance. So that's something you may want to, look into. The currency, inflation, interest rate risk, we talked about a little bit, and people generally are familiar with that. All of that goes in. Now, here I have written underwriting risk, right? I mean, sometimes the processes that go into banks might be flawed, and therefore that could potentially create operation risk for the bank. And that is becoming more and more important aspect from the bank underwriting perspective. So it's like underwriting the underwriters kind of thing, very important. And then the financial repayment and default risk is basically really an amalgamation of all the risks that we talked at the top of the list, the first 10 or 12 of those. Why? Because if something goes wrong, let us say you underwrote it wrongly because your resource estimates were wrong, well, guess what? You're going to look into the default or repayment risk. If your off-taker goes bankrupt, you are looking into the same thing. And these things are never given for granted. The PG&E, for example, which is a utility in the US, despite its reputation as a utility or its configuration as a utility, it filed for bankruptcy 3 times. And you had to basically wait and go and claim your obligations, and it becomes a little bit of a mess. So all of that goes into that. So how do we manage really this technological and resource risk? Because that I have been telling you is the complex aspect. These are all machines, whether you take a wind turbine, whether you take a solar, and for example, nuclear power projects are financed the same way. So think about all the engineering that goes into it, all the technology that goes into it. And so when we are looking at it as a financier, we are looking into, hey, can this thing last for 30 years, 40 years? That's what we are really looking at, right? And so the usually you need to look into the track record, right? Has it been done before? How many times? Who has done it? Where it has been done? Those kind of things. Now we'll talk about technology risk a little bit, but that's an important consideration. So you need to start with the technology that sort of works. You need to work with the people who know what they're doing. Now, some of this sounds, pretty common knowledge and common sense, but believe me, people do make stupid mistakes. I mean, again, in hindsight, everything is 50-50, but we have seen and come across, and sometimes it's one of those things which is penny wise, pound foolish. Oh, we'll spend a penny here, and then we'll go on a cheaper, manufacturer, and guess what? You have a problem. So it's very important that you get this. Then the site selection. You need to choose a site which has access to everything. It's dependable. Your landowners are dependable, are trustworthy. That sort of thing. If you're building a big wind project or a solar project, you need to plan for a lot of things. For example, you're going to need a transmission line, so better be close to the grid as much as you can. And if you cannot, make sure that you have the right of ways so that you can build a transmission line to connect to the grid. Very important. Obviously, environmental considerations are fairly self-explanatory, but that is also very important from the site selection perspective, because oftentimes you may have great land, great resource, you have close to everything, but there are desert tortoises in the case of a solar project. Well, what do you do? And it could be fairly, fairly difficult. One of my bosses actually early in my career gave me an example, and they said, well, desert tortoises cost $50,000 a tortoise. Well, that's just broad number, but you need to bring in expert that costs money. You have to do the surveys. You need to come up with the mitigation plan. So you better should make sure that you're working in an area which is environmentally sustainable. And then the resource assessment. I cannot talk to you enough about this. I do have some engineering background, but I don't necessarily enjoy this conversation because there is a lot of art that goes into it. It's not as scientific as people say. Many times solar is a more predictable than wind, but when solar projects have underperformed and it becomes a mess when you basically have financed the project and it doesn't operate as you expected. So that's very very important, and all of that goes into the financial modeling, the contractual arrangements. Say for example, there's a minimum delivery obligation. Guess what it is? Based off. It's based off the resource. If you are very confident, like at the 99th percentile, that you can meet the minimum delivery obligation, you feel good about it, and that's sort of thing. I will talk about technology choice the next. And so the technology choice really, deals with what technology you are using, right? It has to be bankable, right? And that's one of the reasons why, we have a very few thin film product, manufacturers. Why? Because no one wants to take the risk. This is sort of an anathema to the project finance industry because at the end of the day, all we care about is getting our money back. It's like there is a limited upside and infinite downside kind of scenario. So every project finance banker will tell you, go with somebody who is proven, which is typically in the case of solar PV, turns out to be polycrystalline, right? So that's the way it kind of works. A lot of you, I'm pretty sure, are working on exciting technologies, but guess what? It is really getting harder to finance some of those. Right now, the markets are changing, and there are a lot of organizations like Breakthrough Ventures, which is founded by Bill Gates, which are taking sort of long shot risks with regard to success of some of these technologies. Hopefully that would make life easier. But as a traditional project financing, because you are working on a non-recourse basis and because you are lending to a specially created, newly created special purpose vehicle, you don't really want to take any risk. And I'm an engineer, I am a technologist, and I like to support some of these things. And it's very heartbreaking that we cannot really finance some of these things unless there is a significant track record and things of that nature. From that perspective, obviously, the newer businesses don't have really the balance sheet, and then they cannot provide the warranties, guarantees that could potentially sort of bridge the gap, but that doesn't happen. And so there is a whole slew of things that you need to do when you're working with new technologies, if you at all kind of wrap your head around it. And that's you have to do the bankability analysis. You want to get as much of a turnkey EPC contract. You want a strong warranty package. You want supplier credit, that sort of thing. And then sometimes there are insurances that are available. Zurich was one of the first, Swiss Re and Zurich Re were the first ones to enter the market to wrap some of the risks around panels manufactured in China back in 2012, when there was very little track record for some of these manufacturers, and that can potentially get you a day. But broadly speaking, in the wind and solar industry, and I've been doing this for more than 20 years now, really most of the changes we are seeing are incremental. There hasn't been really groundbreaking results. And some of the companies like Solindra, where I worked, they're not around. And part of the reason was they couldn't really substantiate the claims in terms of having the costs that could be delivered on a consistent basis for a long period of time. They just were too expensive, and that's where it didn't work out. The environmental considerations, fortunately, we don't have to deal with a lot. There are basically ESAs in the US that we need to do, but the process is the same internationally. You basically have two phases. The phase one basically, does a broad brush, environmental assessment. And then you basically, if there are any issues, then you go and you do the second phase. Now, as I said, there is plenty of land available. There are multiple places you could go to. So that is generally not very big. But I haven't really, I made, at least 30 investments when I was at State Street. And really didn't encounter anything worth mentioning here. So that gives you an idea. However, there are issues with regard to the endangered species. You have to worry about, you have to worry about the bats, the birds, the eagles, and a lot of those things. Obviously, bald eagles are very important here from the national symbol perspective in the US. I'm pretty sure in other countries, you have some, favorite birds and you have to take care of them. All of that is very important. And it is very time consuming. And unfortunately, in the US, there hasn't been much guidance. And, fortunately or unfortunately, the renewable energy industry got a kind of a green pass because it is green. But then now what you will find is a lot of people are waking up and there is a lot of scrutiny of renewable energy projects. Some of that is coming from environmentally conscious firms. You may have heard about some of the disputes in Nevada where there was some protest against a solar project because the desert tortoises were getting hurt. You have to be wary of wetlands because wetlands do attract birds. You have to care about the sites of significant historical significance. That goes primarily with the offshore projects. In the US, some of the offshore projects were basically canned, partly because they had something to do with some of the native Indian populace and their traditions. And these are some of the things we need to respect and take into consideration when we are building the projects. So that's what is important. Obviously, having a community support helps, because they are going to benefit from the project economically, and therefore it always helps to have them in your, sort of back court. So that's the nature of it. I'm going to quickly run through, some of the debt financing considerations. There is a possibility that we could do a bond financing, but if you are seeing my earlier slide, the bank loans are predominantly the preferred financing mechanism. Why? Because the credit rating agencies have been really slow and to some degree very conservative. They are fairly long and cumbersome bond rating criteria, and that makes it very difficult. I have given some metrics here, like typically banks are willing to finance renewable energy projects at one-time debt service coverage ratio at a 1-year P99 production level, both for solar and wind, or 1.3 at the DSCR of P50. But bond financing or the credit rating agencies might require 1.5 at the P50 production level. And so that basically potentially kills the economics of the bond financings. And therefore, I haven't really worked on any transaction that I recall which was financed with bonds. So bonds are important when you have very large projects, for example, LNG projects, and again, it's not renewable, but just to give an idea, the size of the projects, that's where the bonds can potentially be helpful because you can have a diversified investor interest, and therefore you could potentially save some money on the interest rate. There is a whole comparison here, which you can go through in your spare time. From the perspective of the the structure itself, there's a lot of stuff going on, right? I mean, we talked about recourse and non-recourse debt. Obviously, here there is no reason why it cannot be made recourse. I mean, all sponsor has to say, we guarantee all of your debt. Doesn't happen all the time, but I'm just kind of giving you an idea. We talked about the project versus holdco debt. I remember I talked about the project lender being here, the back leverage. That's really the consideration around project versus holdco debt. The construction loan and the term loan, generally what happens is you finance the project for construction, and there are automatic triggers which basically allow the lender to convert their loan from construction to term loan, and that's what happens, right? There are fully amortizing loans versus mini-perm. Mini-perm basically means it does have a amortizing structure, but there is a bullet at the end of 10 years, for example, that becomes due. So think about your mortgage. There's a 30-year mortgage, and then the bank says, well, at the end of year 10, you have to refinance that and you have to repay us. Well, how do you do that? Well, you have to refinance that. And it is not a mini-perm is not a good one. Why? Because you do take market risks. For example, currently, the interest rates are much higher than what they were back in the days. And let us say that you had a mini-perm structure, albeit at a lower interest rate. Now, suddenly you are in the market financing at interest rates when they are 3% as opposed to when they were 1% could potentially significantly damage, your project economics. And so money perm is not very helpful or favorable. There are cash sweep mechanisms. Sometimes you may have cash sweep. Basically, the lender says up to a particular IRR, we could take some of the cash and then we take some, you take some, that sort of thing. Sometimes you may have defined amortization. Typically, that goes into the bond kind of a conversation. There are minimum debt service coverage criteria, coverage requirements. There are reserve accounts. A lot of these are, open for negotiation. So that's where the borrower and the lender spend a lot of time, what to work, and how all of it all comes down to the dollars and cents, and therefore it's very important that you get your things right. I have a couple of final slides. So here is some data from Moody's. Basically shows you sort of the project finance default rates for project finance, and it also gives you some information about the recovery rates, right? What I want to do is I want to draw your attention to the left hand, the table in the left hand corner on the bottom. You will see that, basically there are two different criteria or data sets that they use, and they looked into two different definitions of the default. One is according to the Basel, and the second one is according to what Moody's uses, and their numbers are a little bit different, but the story is the same, right? So if you let's look into the second column, which is the Moody's, 1.4%. Basically, I mean the third column, the Moody's rates or default rates. You will see 1.4% going down to 0.03, and there's an average of 0.68. Look into the right corners, which is the last three columns: Moody's A, Moody's BBB, and Moody's BB. These are the equivalent, it's BAA and BA, but I'm using the S&P kind of metric, the nomenclature. But that aside, you will see that the projects have pretty high default rates in the first few years, and they kind of go down quite significantly to like 0.03%. So basically what it means is it has basically a backward data structure. What it means is the first few years of the project are fairly difficult, and then they become pretty much like a bond, which is actually a AAA rated bond or an A rated bond. So that's the way it is. And so this is what the banks are basically arbitraging. What they are doing is they have to set aside a reserve based upon these default rates. They are looking at the average rate, and they reserve accordingly. They have a portfolio diversification to work for them, and then basically they charge you LIBOR plus 200, and therefore make the profit. And this also explains why the project finance loans are fairly important. Now, when I talk about the default rates, you have to talk about the recovery rates too. Most of the time, the recoveries are fairly substantial, and part of the reason is because there are many times most of the defaults are fairly low, as I showed you in this particular chart. But also when this default is for a factor that is outside the control of everybody, and therefore things tend to resolve pretty quickly, and you can get a pretty high recovery. 80% is a pretty high recovery, right? So that's what it is, and you will see that the recovery rates generally are these are averages. The recovery rates during the construction are the lowest, and then during the operation they are the highest. Sometimes actually could get pretty much at par, because all it requires is restructuring some of the debt and making sure that everybody is getting their money's worth and that sort of thing. So it is a very important, sort of data slide. It's a little bit old, but nothing has really changed dramatically. And so, even the data set is a little bit old, you don't have, nothing is getting missed out. So that's all, we have. One last slide. I mean, I know I'm running very fast, but, fairly large slide deck here. All it comes down to, the disadvantages, longer execution time frame. It takes months and sometimes years. Fortunately for renewable energy, it's a little bit quicker because fairly small number of parties, and fairly simplified projects, but it does take longer than typical financing. High transaction cost. For everything, you have a lawyer, there's a consultant, and then the costs just add up, right? the debt is pretty expensive compared to a typical corporate financing. Why? Because the lender is lending into a newly created entity, which is going to be and they're going to be recourse only to the project. So they charge a lot. And I told you how that arbitrage works on the previous slide. The risk allocation is fairly complicated, and that's why you have to have very complicated documentation. I told you you have to keep the project on autopilot. Guess what? You have to think about all the possibilities and exigencies, and therefore you have to think about it. There's a significant lender oversight. I mean, there are monthly reporting. You cannot really go and fix your own project if you are deemed to be not capable of doing it, even though you know what the problem is. You have to follow some of the protocols, and it does become expensive. There are stringent lender reporting, high insurance costs. Remember, you are financing this project on a standalone basis, so you need insurance on a standalone basis as well, which can be fairly expensive. There's a very limited manager discretion. These projects are in the middle of nowhere, so you have to just stop them accordingly, and it is what it is. And then you have to give a lot of disclosure about your proprietary information. So just to give an example, Shell, BP, Exxon, they never did project financing, but some of the lower rated companies did. Why? Because Shell just didn't want to tell them people what they were doing with regard to the project, and they wanted to keep this, all this information confidential. So that's what it is. I think this is what I wanted to cover. This is my book. It's a shameless advertisement, but if you like what I just told you, go and buy my book. I'm not making a lot of money out of it, but hopefully we'll learn from something. So that's all I had to cover. Oksana, I think I'm at the top of the hour, and this is it.
Amazing. You are really in time. Incredible presentation. Thank you so much. I was just thinking while actually listening what you covered, and I'm so grateful because it's pretty much everything that we go through. And during our funding accelerator, we have this checklist, and we go through this point by point. And often developers say, "Oh, like so many questions. There are so many things that you require." And I say, "Well, this is not us who requires this. This is investors. I mean, like Santosh and Silver Peak, we collaborate with them. It's one of our investors, and this is the questions every investor asks." So we basically just relay and prepare you in advance to be prepared for due diligence and for investment process if you're serious about it. So thank you so much. I'm glad that it came from you, Santosh, not from me. So our developers don't think that we are making up things and making life difficult for them. So Vlad, do we have any question? Santosh is like a Swiss watch, incredible timing.
Questions that have been asked, Santosh already covered. But being mindful of the time, we'll just have a couple of quick questions for you, Santosh, if you don't mind.
Maybe one, because we already kind of hit it.
Yeah. Well, first one is relevant to the presentation, and second one, everyone wants to know some experts' opinion on hydrogen. But we'll get back to this. First one is so what is today's capital stack, debt versus equity? And what is the difference between US, European, EU, LATAM, and Middle East? If you could comment on this, please.
Would you know? So, I mean, it's not an easy question. You probably would need to have access to statistics. But if you know anything from the top of your head.
So the primary driver here is tax equity in the US, and in the other jurisdiction. We don't have tax equity, and there are feed-in tariff programs, and there are different other mechanisms. And so from the project financing perspective, financing a project in the other jurisdictions is a lot easier than over here. I mean, just the way it is. That's one important consideration. The other thing is with regard to the market and the liquidity of the market. For example, if you are in a relatively small country, say example Croatia, I saw somebody joining from Croatia. I think one of the first entrant in the chat room was from Croatia. I mean, the market is not deep, and therefore you need to borrow in different currencies, and so it does create a lot of frictions, and it does add up, to the cost, because you are looking at potentially, your revenue stream is in one currency and, your financing might be in different currency, that sort of thing. So that's what, the other thing is. I don't know. I just wanted to give you my top of the head, lecture.
Yes, exactly.
Sure. Well, and quickly, just to get your opinion on hydrogen and what is investors' interest, do you think hydrogen will actually surpass at some point batteries, and do you see it as a basically energy of the future?
Yeah. So hydrogen is a big buzzword right now. I got dragged into that until the beginning of this year. I was dragging my feet, but we do see a lot of opportunity. Partly because hydrogen provides a movable storage, right? Basically, I mean, not necessarily hydrogen is in its gaseous form, but in the liquid form as well as in ammonia and some of the other derivatives. Given the reliance and some of the geopolitical tensions we are seeing on natural gas in Europe, people have woken up and they find that hydrogen could be the stopgap measure. And that's true. So I believe that hydrogen is going to be on everyone's mind. There will be a lot of enthusiasm and excitement about it. But I want to caution that at the end of the day, hydrogen is not a perfect solution. It can, sort of make you, it can be very versatile and flexible in some unique situations. For example, refineries or, for example, fertilizers, because green ammonia can be has a carbon footprint which is 75% of the regular ammonia. So that's very important from the tackling the global climate change problem. But the issue is it's not really, if you look into the life cycle of the energy, it's not really efficient, and that's what is going to come to bite back at some point. But in the next 5 to 10 years, we'll see a lot of hydrogen projects, and that's the right path to take.
Great. Thank you very much. We won't take any more of your time.
Thank you very much, Santosh. I really appreciate you kind of dedicated your time to join with us. Very interesting presentation. We will share the handouts with everyone who have attended today. We also will be sending replay because a lot of people who registered with prohibitive time zones and other things. So we also will be sharing the handouts to everyone who have registered but couldn't attend, as I said. So Santosh, I look forward to seeing you here in Dubai. I think you will be coming soon,
hopefully.
right? Okay, fantastic. You have a great day.
Okay.
I wish everyone a fantastic day, and thank you very much for joining us.
Thank you.
Thank you.
Bye-bye.